Good day, everybody, and welcome to our webinar with the CoreShares team on ETFs and how they've grown over the years. My name is Dineo, and I just want to make sure before I hand over to Chris from CoreShares, I just want to make sure that everyone can hear me. So if you can hear me, please could you lift your digital hand? It's a little hand icon. Okay, perfect. Chris, hello.
Hi, Dana.
Okay, over to you.
Thanks very much for the introduction, and once again, thanks to you and your team from Standard Bank Online Share Trading for hosting us today. But most of all, thanks to everyone for tuning in of your and making time in your busy schedules. As per usual, we're going to try and make the webinar short and sweet, and if you've got any questions afterwards, please feel free to drop them in the question box and we'll try our best to answer them. If it's more platform or online share trading related, I may ask Dineo to step in and help out. But otherwise, thanks very much for tuning in today. My name is Chris Rule, and I'm from CoreShares Asset Management. As Dineo said, we run a number of ETFs, but we're really all about anything that's passive investing or low-cost rules-based investing. And today we're going to be chatting about the history of passive investing and kind of some of the seminal moments in passive investing and some of the massive influences and look at the growth, because the growth has really been quite astounding, and certainly in the last 15 years. So to start off, we're just going to have a look at some of the key events in terms of when funds listed, just to give you some idea of actually how long passive's been around, certainly globally, but also in South Africa, passive has been around for a long time, even though it's only recently that it's receiving a lot of recognition and it's receiving a lot of popularity amongst investors. In the beginning, really where passive came out of is a man called John Bogle. He's the father of passive investing, and we'll be chatting a little bit more about him. But in 1951, he published a thesis at university under the guardianship or the guidance of Dr. Samuelson, who's one of the foremost economists of the 20th century. And really, it was one of the first ever research pieces to potentially explore that active management on average doesn't outperform the market average. So in other words, active managers aren't actually beating the market, which in those days it was perceived as such an easy thing to do. So that was kind of hugely important and potentially one of the things that triggered John Bogle's thought process before he launched the first mutual passive or index fund, which was the Vanguard Total Stock Market Index Fund in 1976. And we'll chat a bit more about this stuff. But post 1976, 1993, which is a very recent history in terms of investment management, was the first ETF to list, which was a SPDR ETF. SPDR is State Street, which is a large US bank, and they listed the first S&P 500 in 1993. Only in 1996, so 20 years after Vanguard launched their first mutual fund, was South Africa's first index fund launched, and it was in a unit trust format. So similar to the US, where their unit trust equivalent came out first, and then 2000, our first ETF came onto the JSE. And it took some 50 years for South Africa, 40 years to launch the first S&P 500, which is basically what Vanguard launched in 1976. So South Africa, although we have a lot of great product and there's a lot of growth and excitement around the passive market, we really are a long way behind some of the early acceptance and early take-up in the US. To give you an idea, in 1976, when John Bogle first launched that Vanguard fund, it was known as Bogart's folly, because, or at least Bogle's folly, because in the early days when he launched it, they were aiming for a total subscription of $150 million, and they only actually received $11.3 million. So it's taken a while, and you'll see in the numbers, for passive investing to get broad acceptance in investing. And we're going to talk about some of the catalysts for this growth and some of the reasons why they've grown, why passive has grown. So I'm sure many of you have never heard of John Bogle. In fact, he's not someone who is widely known by the investing public outside of really the institutional and investment professionals. But Bogle has been credited with a lot of what we call the democratization of asset management. So taking asset management to the retail mass, saying that this is something that anyone can do. You can invest in small funds. And as I mentioned, it really all started in 1951, where John Bogle's senior thesis at Princeton, he hinted at an idea of an index fund. So perhaps active funds have no claim of superiority over the markets, is kind of what he was hinting towards. And that was the basis of his thesis. So although he never outright decided to launch an index fund at that point in time, he was of course a student, but it took a further 23 years actually to come and launch a unit trust. I'm going to call it a unit trust. In the US, it's called a mutual fund. So in one of the triggers was his university professor, Dr. Samuelson, challenged the industry to launch an index fund in 1974. In fact, he didn't even challenge the industry to launch one available to the public. He challenged some of the big institutions simply to launch an index fund that could sit alongside their active managers and really gauge whether they were good or not. So along in 1976, Vanguard, which John Bogle founded, launched the first index mutual fund. And as I spoke about earlier, this fund wasn't launched with great success or with great popularity. In fact, it took many years for it to generate the scale that it now is at. It's the largest mutual fund in the world right now. So outside of ETFs, it's the largest actual mutual fund in the world. So, I mean, of course, the premise of passive is that on average, active managers tend to underperform the index. And really what adds significant value to investors over long periods of time is that index funds eliminate the risks of individual stocks. They eliminate the risks of overexposure to market sectors and manager selection, importantly. And they give you access to the stock market at low cost, so much lower than typically what would be active management costs. Average active cost in an equity fund is around 1.5% to 2%. In the passive world, our S&P top 50 ETF and our unit trust is at 0.2%, so a significant cost reduction relative to active peers. And really, that's what passive is all about. So John Bogle is really the father of passive investing. His thesis and then his first launch of the Vanguard Index Fund, which he was the founder of, is really what put the stake in the ground to say, let's start passive investing. But as I mentioned, there was a very slow take-up of passive, and it wasn't the outright slam dunk that it was expected to be in the beginning. And there are a number of catalysts for growth, or a number of reasons why this growth has been so great. The first catalyst really, which led to John Bogle launching an index fund was Dr. Samuel's article, A Challenge to Judgment, so where he challenged the investment world to launch a low-cost passive fund. And combined with that was Charles Ellis publishing an article which received wide acclaim called The Loser's Game. So I explained Dr. Samuelson. He is one of the most highly regarded economists of the 20th century. He was professor at Princeton University and really one of the global thought leaders when it comes to investing and economics. Charles Ellis, another name you may not have heard of, but he is really a legend also in the investment management world, and partly because of his his publication of The Loser Game, and then I'll explain what The Loser's Game is. But also, he was well known. He launched Greenwich and Associates, which was a asset consultant. An asset consultant is basically an advisor for the big institutional money. So for the big US endowment funds and pension funds, these guys are actually the guys who advise them how to invest the money. So that's what he did. And very controversially at that point in time, he recommended that, in fact, the best thing to do for these funds was to just invest passively. Now, at that point in time, and in fact, still to date, a lot of these asset consultants justify their fees by using highly complex investment strategies, and that's one way of them being able to entrench themselves in the industry. So he launched this, or he wrote this article which was famous, called The Loser's Game, and that also got John Bogle thinking perhaps there is an opportunity to launch a passive fund. Just to give you some background so you understand what The Loser's Game is Charles Ellis had been reading a book about tennis, in fact, and the book was called Extraordinary Tennis for the Ordinary Tennis Player, and he describes tennis as being split into two categories. One was professional tennis players, and that was the winner's game. That was a concept where points were won because of superior skill. So points were won because one player had in fact outplayed the other player. In contrast, he then calls amateur tennis a loser's game. And the reason why he says that is because you tend to win an amateur tennis game not because you outskilled or outplayed the other tennis player, but because he lost more points than you. So he in fact lost as a function of him losing rather than being outskilled. He then goes on to say that he thinks that the investment profession is a loser's game, where investors tend to lose, or investment tends to be more a function of losing out because investment managers are making mistakes rather than them being able to outskill each other. So this at the point in time was very controversial, and him being the chairman of the Yale Endowment as an example, which is one of the top 10 endowments in the world. This is really where the big money sits. Made a massive impact that people started thinking, hang on, maybe there's a smarter way to allocate money as opposed to just trying to seek outright active funds. Another massive catalyst, so that was a precursor to the fund launch. Then John Bogle launched his Vanguard fund. And then in 1977, and this was huge, is typically at that point in time, all funds were loaded with an upfront commission. So if you bought a unit trust, you actually got charged a commission from your advisor. Vanguard eliminated what was called all sales charges. So the upfront commission was there. Now that's something that's commonplace now, but in those days, it most certainly wasn't. And of course, they launched a fund at a low cost. And then in most recent history, we've seen Warren Buffett's bet with Wall Street, famous bet where Warren Buffett, in fact, bet Wall Street to say any hedge fund manager can challenge me, and he can say he can choose his best hedge funds, highly complex and highly expensive funds that will outperform a very simple low-cost strategy like the S&P 500. So that a lot of publicity around that. And then the global financial crisis led to investors seeking out more transparency. They didn't just want to buy a hedge fund with derivatives, and the mortgage-backed security crash of 2009 was in a large degree a function of opaqueness in financial services. So in other words, you actually didn't know what you were buying. Passive gets around a lot of that. So as an investor, at all points in time, you're owning the underlying, you're owning it in exact weight of the index, and you know what you hold. It's fully transparent from that perspective. So these are some events for the growth, massive influences which have contributed to the growth. Overriding kind of consistent events where there's been a gradual increase, and that's the first thing is availability of information. If you were investing in 1974, there wasn't much investment information available to say that one fund was better than the index or worse than the index. You couldn't simply go onto your computer and Google and get an index fact sheet. In fact, the broker would come around to your house, knock on the door, and bring you what he wanted you to see, and then you would be investing. So availability of information has been a massive catalyst for growth. That combined with more of an approach of evidence-based investing, where investors are more inclined to invest in strategies where there's evidence of success as opposed to a promise of success. So the smartest guy in the room promising something that cannot be empirically proved, like a passive strategy. And then, of course, the regulatory environment. Regulators globally, specifically in the US and even more so in SA with RDR, are pushing for more transparency, low fees, and all of this is tending to play out in the favor of passive management. So when I was talking about information and evidence-based investing, it's reports like this that really are proving time and time again that passive investing is a really sensible way of allocating your money. So this is the kind of evidence that is now available to investors on an ongoing basis, freely available, where they can actually establish that, hang on, active managers aren't all outperforming the index. And in fact, and this is a relatively consistent stat, over most periods, 80% of fund managers will underperform a simple cap-weighted index. And the irony is that, let's call it 20% of active managers who do outperform don't do so consistently. So the fact that you selected yesterday's winner doesn't mean that you're going to be tomorrow's winner. You're not necessarily going to be in that 20% outperformance. In fact, there's a high probability that you'll be out of that outperformance category in the next 5 years. So these are some of the catalysts and the components that have led to this really extraordinary growth in passive. And some of the, of course, tailwinds that we're really excited about as a passive investment management business at the same time. And investors have a lot more at their disposal to make good decisions, make good investment decisions nowadays. So I've been talking about this growth. What does it look like? Let's have a look at the global snapshot. So what we're looking here is from 2005 to 2017. This is the data that's available to us. So pre-2005, you'll actually notice that there wasn't a lot of money allocated to passive. So only $417 billion allocated to ETF passive investments. Now that might sound like a lot, but in US terms, that's very small. And what you'll see is a really extraordinary growth in the US 2005, 2008, 2009. You can see, of course, there's a drop-off during the global financial crisis, but then a massive pickup post that. And that can be put down to a number of factors, but Warren Buffett's bet with Wall Street, there was a lot of popularity around passive. If Buffett was backing simple passive strategy, then maybe it's a good idea for me. I think there was a lot of herd mentality that thought that this was a good idea, and in fact it was. I'm sure, as you know, Warren Buffett, in fact, the hedge fund manager who took him on of Protege Partners has conceded. He's actually said, okay, I'm out, I've lost. And this is over a 10-year period with a crisis and a crash where hedge fund managers are meant to be adding value. So there's the Buffett bet, there's global financial crisis where these opaque structures of investments where you couldn't really see or understand what you were investing in. But then there's those tailwinds of information being available. Hang on, I'm going to go and invest. I'm not just going to pick an active manager because I can see he's actually underperformed. And those numbers are available to me in terms of in a democratic way. So they haven't been presented to me by a sales broker from one of the active management firms. So the growth was really astounding, from $417 billion to $4.3 trillion tracking ETFs in the US. Another stat is that the number of ETFs has grown astoundingly to 5,179 ETPs or ETFs globally. That's not always a good number for investors because, of course, it makes your life slightly more complicated in terms of what to select, how to select. We default to say, you know, it's always a good strategy to buy low-cost, simple S&P 500 or South Africa top 50. If you don't understand what the other ETFs are doing, that's a very reasonable allocation to make. So you can see the global growth has been, in fact, quite phenomenal. Over the last 5 years, Passive has gone from some 5% of global assets to closer to 20% now. It is about 20% in the US. Globally, it's slightly lower, around 15%. So really a phenomenal percentage of total assets, but still less than active. So active is still, the vast majority of assets, around 80%. But what is astounding is money is flowing out of active and into passive. So active over the same period has had almost identical outflows. So the money is coming from somewhere, and it's not necessarily all new money that's being allocated to passive. A lot of it is people saying, hang on, I'm actually being ripped off in this active strategy. I'm sitting in a high-cost fund that's 2% a year, and the active manager is underperforming the benchmark. So why don't I de-risk the manager risk and allocate to a low-cost passive strategy? In South Africa, we haven't seen the same kind of growth. We, of course, are a very long way behind the curve. As you saw, we were 20 years behind the curve in terms of the first passive fund that launched, and 10 years behind around on the first ETF that launched. So we've got a long way to go in terms of educating our public, in terms of educating advisors, importantly, that they shouldn't just hold the big brand active managers anymore. There are other solutions which are equally good and significantly cheaper. So in the local market, we haven't seen significant growth. But still, from 2008, 16 billion Rand tracking in ETFs on the market, up to 87 billion Rand in ETFs in the local market. So there has been growth, but we expect the growth to continue to pick up and continue to grow. So that's our little story about John Bogle, Charles Ellis, Dr. Sanderson, Warren Buffett, and the guys who really were the catalysts behind passive growth. I hope it's given you a good overview of why passive has grown so much, and in fact that this wasn't an overnight success. Overnight successes are usually long times in the making, and passive, although it's on the radar of everyone in the last few years, in fact has been bubbling under the surface since 1976. So this hasn't been an overnight success. It's taken a long time for passive to prove its worth in the sun, and I think that's truly is what's happening in our global financial services markets. So that's it. If you have any questions, please drop us questions in the question box. I may ask Dineo to step in and handle a few. But just to finish off, the case for passive, of course, there's been this massive growth, but the first thing is transparency. So clients know what they're buying. They know the underlying holdings. They know it's full replication. In other words, you actually buy the shares. They're liquid and flexible. You can trade them on the market in and out. Typically, ETFs are only as liquid as the underlying market. So if you're buying a top 50 ETF, you can buy 2 billion Rand today. You can buy 10 billion Rand today. We can provide liquidity. If you're buying a pref ETF and you want 10 billion Rand, you quite simply can't do that. So it's on a look-through basis in terms of liquidity. We make a market, so we make sure pricing is fair and a bid and offer. As an investor, you can buy one instrument and get a diversified holding. So that's massively important, especially for more retail DIY investors. You're not buying one share. Recently, a company, Consolidated Infrastructure Group, crashed some 60% on one day. So as an investor, it in fact doesn't qualify for the top 50. It's a non-event. If you're buying an all-share fund, it would have hardly even hit the radar. But if you were 10% of your portfolio or 20% of your portfolio, you would have felt that. They're highly regulated. FSB and JSE has a clean look through in terms of the regulatory environment. They aren't opaque instruments. And of course, they qualify for tax-free. And one of the most important things is they're cost-effective. So as I mentioned, active in South Africa coming in around 1.5%, and passive coming in at between 0.2% is our top 50 fund. And there's even some ETFs at 0.15% as a TER or 0.16. So they're getting really cheap in South Africa, and we're seeing them get cheaper as they get bigger. So it becomes a self-fulfilling prophecy. The more people invest, the cheaper the managers are able to get them down. To give you an idea, just as a last interesting tidbit, the largest ETF in the world is the SPDR S&P 500 ETF, and that was the first ETF that was listed. It's got about $230 billion tracking it, so about 3.5 trillion Rand, which means it's about 25% of our total exchange in one fund. It's the third largest ETF in the world. The costs around 9.5 basis points, or 0.095%. So really, at that kind of scale, you can get really cheap, you can get really efficient, and you can get really liquid, and that's where we think the local market. So as long as investors keep backing them and they see the value proposition, I think we're going to get this. If you've got any questions, please drop them in the question box. Otherwise, thanks very much for joining. One of the hooks of today's message was we were going to be have a competition to hand out a book. The book is by John Bogle himself, the father of passive investing, and the competition is pretty simple. All you need to do is on your Twitter feed, just answer the question, tag CoreShares at CoreShares, and the question is, who is the father of passive investing? And then you stand the chance to win a book. We'll randomly select one of the tweets, and the book is the Little Book of Common Sense Investing, which, by the way, it was of course written by John Bogle. He's the founder of the largest asset management business in the world, and Warren Buffett endorsed this book, saying that all investment managers, both professional and retail, should be reading this book. So that's the little competition we're holding today. Really is a fantastic book. I've read it about 5 times, and if you haven't read it, I'd really recommend you go out and get it. It's got some very good investing principles.
Okay, Chris, thank you very much. We have several questions, so I hope you're ready. So the first question is, what's the fundamental difference between an ETF and an index unit trust?
So the fundamental difference is actually not significant. An ETF is a unit trust whose units trade on an exchange like the JSE. A unit trust trades over the counter, so you'll interact directly with, like, CoreShares, for example. So in fact, they're very similar. It's just the mechanism of accessing it or buying it. An ETF you'd buy through your stockbroking portfolio. The unit trust should go direct to the asset manager and buy it. And that's as simple as this.
And okay, this is a CoreShares related question. Are there plans from Core? Okay, so I'll ask you 2 questions just so that we can get through them, because there's quite a few. This is, are there plans from CoreShares to issue more global range of ETFs, or more global ETFs? And do you think we could see an oversaturation of the ETF market, extrapolating this intense growth, maybe 30, 40, or even 50 years into the future?
So, yes, we're working on an exciting new global product. It will be a world product, but maybe slightly different to anything we've seen on the JSE. And we'll have more information about that in the early new year. So we're really excited about that to give you some feedback on that. Yeah, I mean, there's a lot of competition in our little market. So we're seeing a lot of new ETFs coming, a lot of new ETF issuers coming, which is really actually good for the industry. We think it's fantastic. It's raising the profile of the industry, the passive industry. It's raising awareness, and it's good for customers. It means there's more pricing pressure, there's more competition, and we love it as issuers, because it obviously clarifies and justifies our place in the sun. But also, you know, if I can compare it to the active fund manager industry, people often forget to say, well, now there are 5 really, let's call it ETF issuers on the JSE, or passive issuers. In the active world, there are hundreds of active asset managers. In fact, there's 1,700 active unit trusts available to you. There are only 80 ETFs, or ETPs at least, 50-something ETFs. So yes, products are growing, and there's a lot of product coming out. But I think we've got a long way to go until we reach a saturation point where, you know, it no longer makes sense to create more product for clients generally, I think it's a great thing for clients. So, yeah, that would be my response. Is maybe it does seem like there's a lot of people coming to this market, but if you compare it to active, really, we've got a long way to go to reach the point of active. To give you an idea, passive in South Africa is around 3% of total assets. But globally, it's about 15 to 20%. I mentioned about 20% in the US, which is the largest market. But in South Africa, it's only 3%. So we think we've got a long way to go in this passive growth story.
Okay, and sorry, my screen just disappeared. Okay, so the next question is, can you, or what will be the best defensive ETF in our soon-to-be junk environment? And can you do something for a breakdown to analyze what ETF, ETN to buy? I think we might not be able to do that right now, but perhaps, Chris, you can talk about any strategy ideas for that people can use to protect themselves from market reversals.
Sure. So market reversals is quite broad. You could be talking about global stock market reversals, local stock market reversals. There's a lot of concern, of course, around our local micro environment, our social and geopolitical risk that sits in South Africa at the moment. A natural way to hedge against that risk is to buy global strategies. There are a number of global ETFs available. We have an S&P 500 fund, which gives you US dollar exposure. It gives you hard underlying share exposure in the US. So that's like a pure hedge against South African risk, as it would be a global property strategy. I would recommend that you do your homework. There are a number of global strategies available out there. In terms of a global sell-off of equities, that's more difficult. What we tend to recommend is that you select the right fund for you. So are you young with a 30-year time horizon? You should, rather than trying to time the market, spend time in the market, be consistent. Typically, people can't time the market, so people who try and buy and sell to anticipate crashes or anticipate bull runs, they tend to get it wrong. In fact, they do get it wrong. Research would suggest that not even professional investors are getting it right. They're getting it wrong most of the time. So we would recommend that you spend time in the market and don't try and time the market. However, if you did want to be more defensive, allocations to cash ETFs, allocations to global bond ETF, there are asset classes which by their very nature are more defensive than equities. So that's one way of getting more defensive. Of course, then you're falling into the trap of trying to time the market. So we would rather recommend, choose a reasonable asset allocation and just stick with it. Stick with your guns through the crashes, through the bull runs, and off you go. So unfortunately, I don't have any pearls of wisdom there, but rather to try and invest consistently and spend time in the markets would be our kind of message for avoiding a crash. Or there's an interesting slide I saw the other day that was put up from 2009 to 2017. Every single year, there's been a headline in the Wall Street Journal that said, "Easy money is over, we're in for a crash." So if you had pulled your money out at that point in time, it doesn't matter how much downside you had protected, you will never catch up with the investor who had simply stayed in. And that's the message behind the Warren Buffett bet, where in 2008, when Warren Buffett took the S&P 500 versus hedge funds, of course, trying to time the market to an extent, trying to offer you downside protection, they got the financial crisis. So they got that massive drawdown event of let's call it 40% in the S&P 500. However, because of them trying to time the market and getting it wrong and trying to offer downside protection at very high cost, they've actually underperformed post that. And they've underperformed cumulatively at a very significant level, something like, off the top of my head, 60% cumulative underperformance, which is a big number. So, yeah, timing the market, we wouldn't really recommend.
Chris, there's a question here about, what is the advantage of investing in the S&P 500 or total world stock locally versus offshore? So I think basically, what's the advantage of offshore investing, and do ETFs pay dividends? And what is a typical range of annual returns on ETFs? That might be a bit tricky to answer, but yeah.
Yeah. Okay, so we've got three questions. I just want to make sure I've got them. We've got going offshore versus buying local. Okay, and I think I know what you mean. And then the second one is dividends. And then the range of return. That's going to be hard to respond to, but I can give you some kind of an idea on that. So in terms of going offshore versus buying local, a massive consideration. So let's take the S&P 500 as an example. You can either buy it on the JSE through CoreShares, or you can go and buy it through John Bogle's business, Vanguard, the S&P 500 in the US. The benefits of buying it in the US are that it's cheaper there. So that S&P 500 is around 6 basis points, I think is the correct number. So it's much cheaper as an ETF, but you pick up significant costs as a retail investor. So when you invest, you're buying dollars, so you're picking up a massive currency spread. What we've seen for retail investors is currency spreads of between 6 and 9 cents on the dollar, which means you're paying between 0.5% and 1% off the bat just to buy dollars. So that's quite opaque. You don't see that. They're often also minimum charge incurred, so like 350 Rand to transact in foreign currency. Which, if you're investing 100,000 Rand, it doesn't sound significant, but that's 35 basis points off the bat, plus your extra percent to trade in and out. So there's a lot of costs that are involved with moving your money offshore, which typically don't make a lot of sense unless you've got a large sum of money. So unless you've got, I mean, we did the numbers for an institutional investor the other day, and depending on what you're paying on your currency spread, but let's say you're paying about 4 cents on the dollar. So in other words, 4 Rand cents per dollar you buy, you're paying as a spread. It's not something you're going to see explicitly. The foreign exchange brokers in their infinite wisdom won't show you that, but that's what you're going to, the price you're going to get. If the Rand is trading at 14, you're going to actually buy it at 14.04. So that's what I mean by the spread. Unless you have around 30 million Rand and plan on investing consistently for about 5 to 10 years, it tends to make more sense to buy it locally because of those FX spreads and the FX costs and the cost of holding assets custody offshore. So that's the problem. So what we see is typically large institutional investors, they take their money offshore and they go and buy the Vanguards and BlackRocks of this world. And smaller multi-managers, so guys who are spending 10 million Rand, 5 million Rand, private clients who are taking a 10 million Rand allocation in a global property, are best served buying it locally. So that would be my kind of, just to give you a rough idea. And of course, you must do your own homework. Don't take my word for granted. Go test my thesis. But that's what you have to look out for, is the currency cost and the cost of holding a brokerage account offshore. You need to take that into account. Dividends. Some ETFs pay dividends, some don't. In fact, in the global space, some of the ETFs more recently launched by Satrix don't pay dividends. So that may be a good or a bad thing for you. Our ETFs pay distributions semi-annually. So you just have to look at the individual funds. But yes, that's something to look out for. Returns, in terms of the returns that you can expect from ETFs, it really depends on what ETF you buy. As I mentioned, ETFs give you effective or efficient exposure to asset classes. So you can actually buy a cash ETF. ABSA has a cash ETF called the Tracy, I think it is. And that you could expect 5 to 6% a year, let's call it now. You could go and buy the S&P 500, which over the last year has given you 39% as a function of a weak Rand and strong US market. So, you know, it depends what you're buying. Typically, equities over long periods of time would give you around 15%. When I talk about long periods of time, I'm talking about 10, 20 years time horizon. Property, a very similar level of return. Bonds, 9 to 10%, and cash close to 10%. So you're taking on more risk by moving from cash to bonds to equity, and you would expect to get higher returns. So really, there's a very wide variance of returns, so I can't give you an exact number.
Okay, thanks, Chris. And a question on India and okay, so India obviously lots of potential there. We just wanted to know, do we have any ETFs that cover India? Does CoreShares have any?
Yeah,
Or with
CoreShares doesn't
exposure
have
to
any, and no. In fact, there are no ETFs in the market at the moment that give you exact Indian exposure. I have no doubt that in the next, I don't know, a couple of years, there will be something. The problem with all these individual markets, and what you tend to see is there'll be S&P 500s, and then there'll be Europe as a whole, so Germany, France, etc., etc. There might be the large individual markets. At the moment, India is very much an emerging market. I agree, there's massive potential in the Indian market. But with all these ETFs, it's a scale game. So an ETF provider is not going to list an ETF unless they think they can manage 10 billion in it in long term. So at the moment, I think the problem with India has been there hasn't been a business case. I think there's an opportunity to list an Indian ETF. We certainly not going to be doing it in the next 6 months. But I would keep your eyes peeled, and there may be something. If you go offshore, if you go into the US markets, go into the European markets, into the UK markets, there are Indian ETFs, which give you exposure to the top 50 largest Indian companies, and give you exposure to that growth story, which is obviously very exciting. But locally, no, there's no passive Indian exposure at the moment. So sorry, a long answer just to tell you that there's nothing available, but there it is.
Okay, great. And sorry, guys, there are quite a few questions. So I'm trying to go in order of the questions. There were quite a lot. Question on ETF fun fact sheets. Yeah, fun fact sheets. Do all ETFs have those? And maybe, Chris, could you just touch on what information would typically be can be found in an ETF fund sheet?
Sure. So yes, by regulation, all ETFs must have fund sheets or fund fact sheets. They're now called MDDs. So the FSB has put a nice technical name for them, which means a minimum disclosure document. And the kind of things that you should see there are returns. You should see all the role players. So who is the custodian, who is the asset manager, all those kind of important facts. You'll see the fees, the TERs. One important note is that you can only publish a TER after 1 year, and you can only publish performance after 1 year. So you might find a new ETF that don't have performance numbers and they don't have TER numbers. So that's frustrating, but it's not there. You should see holdings, all the underlying holdings on a fact sheet. You should see who the management company is, who's responsible. So those are the kind of things. You'll of course see the fund objective. You'll see which index it's tracking, and in time you'll see when it's got performance. You'll be able to see the tracking area, the price of the ETF. So a lot of information. I've briefly gone over it. That's available for you in those fact sheets.
Okay, thanks. Thanks, Chris. And Sigalelo, if we usually send out an Sigalelo was just asking about the lithium ETF, and I'm just trying to get some information from the guys whether or not we'll be offering it, but we usually then send out an email to all OST clients to tell them that there's a new ETF out, and then you'll be able to get a direct link to it on the platform. Okay, and then I think we're done almost. Okay, and Chris, I think you probably did touch on this. Rod wants to know where he can find shares that are held in an ETF. Could you perhaps, for those who are tracking the markets, how, how, how would they find that information out?
Yeah, so the shares that are in the ETF would be on the whoever the ETF issues website. It's a compulsory disclosure, so we have to show exactly which shares are in the ETF and which weights they are in the ETF. They'd also be on the fact sheets. So there are a number of places you can go find them. Also, a lot of the index providers will show you exactly the holdings. So S&P Dow Jones, for example, will give you a fact sheet. So you can look at the index and you can look at the fund next to it. So it's really there. Just go to Google and Google, like if you want the top 50, Google CoreShares top 50, click through to our website and all the information will be there. The same can be said for Satrix, et cetera, et cetera. And we try and keep those as up to date as possible. So you'll see that the information is frequent and really freely available. Of course, one of the major benefits of passive investing.
Okay, thank you very much, Chris. If anyone has any other questions, please could you send them through. And while we wait for that, Chris, do you just want to give out the competition details again so that those who want to participate can?
Sure. So it's a really simple little competition, and the question is, who is the father of passive investing? And then, of course, you stand a chance to win the book, which is a really fantastic book. It's called The Little Book of Common Sense Investing. And all you have to do is tweet at CoreShares and give us your answer. I have mentioned his name about 500 times in this webinar, so I hope you've got it. If you don't, just keep your eyes peeled. Slides, and you'll see perhaps who he is. So it's really not rocket science here. You should get this one. And then we'll randomly select someone from Twitter, and how we do that is, being computer geeks and numbers geeks, we put it into an Excel random generator and it spits out a name, and then we select that. So it's pretty fair in terms of who's going to win the book. So please enter. It's a great book to read. It really is it's not an intimidating investments book. It's
Chris, okay, so Robert, I think your question, so Robert wants to know about, do we have concrete stats? Generally, the cost of ETFs is available on the fund sheet, but do you want to perhaps go into how people can compare the cost of an ETF to an active management, and what they should what they should look out for when comparing costs?
Sure. So it's pretty simple. I mean, what the investment industry does have is a lot of standards, common reporting standards. So if you go into an ETF fact sheet, you can pull up our TER, and you can go pull up an Allen Gray TER from their fact sheet. What I would encourage is comparing like for like. So if they've got an Allen Gray equity fund compared to one of our equity funds, and compare the TERs, you'll see they're markedly different. And then you should also be comparing TICs, where those will also be different. A TIC is a total investment charge. Typically, passive would be cheaper, like even cheaper on a TIC basis, because they tend to trade less. So active managers are trading in and out of shares, and TIC includes transactional fees, where TER doesn't. So it's really as simple as that. Sites like ETF SA have a lot of information around ETFs, and you can go there. You can have all the ETF information available to you, where you can just see the fees all on one page. Active management fees you're going to have to go and get from their fact sheets or their MVDs. The stat is the ASISA stat, and I do stand to be corrected. The average retail class active equity fund is 1.56%.
Okay, Chris, thank you very much. I think we can wrap up now. Do you want to just share contact details in case anyone has follow-up questions?
Sure. So please, if you have any questions, drop us an email. There the email details are. That's info@coreshares.co.za, or give us a call on 011-321-5571. We'll be more than happy to field your questions. And thanks very much again for joining us today. I really appreciate you taking time out of your schedule to listen to us chat about passive growth and some history on passive investing. I hope you found it interesting, and perhaps go read up about some of those guys I spoke about, Charles Ellis, John Bogle. They really are the unsung heroes of investment management world, and probably people you haven't heard of. Of course, you've heard of Warren Buffett, but that's interesting. And also, I suggest you read up about Warren Buffett's bet with the hedge funds. It's a fantastic story of how a simple, low-cost investment is most sophisticated hedge fund investors in the US. So give that a read. That's also interesting reading.
Great. Thank you very much, Chris. And to anyone, if you have questions specifically related to the online share trading ETF offerings, please, you can send an email to securities@standardbank.co.za, or you can send us a DM on Twitter. Our handle is @SBGTraderZA. You can just send us a direct message with your queries. And thank you very much, everyone. Thank you for tuning in, and enjoy the rest of your week. Thank you, Chris.
Thank you, Danae. Thanks, guys.